From Magnificent 7 to Fabulous 4, we are looking at a new crop of AI leaders. Maybe the Fed may not cut interest rates in 2024. Remember, be able to license out their FSD platform for other car companies, so there could be some monetization opportunities for Tesla in the future. This is an incredibly tough thing to do. And Warren did it. He paid attention to Munger's advice of buying great businesses at fair prices rather than buying fair businesses at great prices. Welcome to Signal, where we analyze business and technology market trends and separate signal from the noise to help you and your organization to transform with AI and digital. If you're new here, please like and subscribe. The AI rally is one of those things that has really helped the market to gain ground despite the increase in interest rates by the Federal Reserve in March 2022. The Fed just started raising interest rates at a quarter of a percentage point at that time. And then we've seen the Fed stabilize interest rates and hold them steady at 5.25 to 5.5% now in late 2024. And we're seeing that despite these increase in interest rates, the AI rally continues to go up. Torsten from Apollo, who's one of the most widely regarded economists, said that the Fed may not cut interest rates in 2024. The Fed promised us three interest rate cuts in 2024 when they announced that back in late November of 2023. And what Torsten is saying that a reacceleration of the US economy and a rise in underlying inflation might prevent the Federal Reserve from cutting interest rates this year. And what that means for the markets is pretty clear because the markets have been, quite frankly, pricing in some of the Fed rate cuts ahead of the actual cuts. And so if we don't see those rate cuts happening in 2024, it is possible that the AI rally might take a pause. But if that doesn't happen and Fed actually reduces rates in 2024, we'll continue to see AI stocks continue to rally in 2024 and beyond. These new crop of AI leaders are a subset of the Magnificent Seven. And these stocks specifically are Amazon, Meta, Microsoft, and Nvidia, who've shown fantastic performance. However, three stocks have specifically lagged the market: Apple, Alphabet, which is Google, and Tesla, which is leading analysts to believe that it's really the fabulous four for the market, which are going to be the new leaders going forward rather than the Magnificent Seven. Now, since we're talking AI, it is useful for us to take a look at how are these AI leaders monetizing AI. In other words, how are they actually making money off of AI infrastructure, software, hardware, etc. Let's do a high level view of monetization of AI. And in this high level view, let's take a look at products, business model, pricing, go to market, and we'll also look at some possible under monetization of opportunities. But despite all of this, right, let me just say something right out the gate. We're still in super early stages of monetizing AI. So what we are seeing is as these companies start to monetize their platforms, this is very early days and it's still not super clear where the monetization and value capture of AI will occur. So let's take a peek at some of these companies and how they're monetizing AI. Let's start with Amazon. And from a product standpoint, as you know, Amazon has AWS as their cloud platform. They also have chips like Trainium and Inferentia. They recently released Amazon Q, which is a LLM chatbot that they have developed. And from a business model standpoint, they are absolutely monetizing through the cloud platform, which is AWS. And in addition to that, they have additional microservices, APIs that they monetize. And the way they price it is primarily through the AWS usage based pricing. And there might be some subscription pricing for the queue, although it's not super clear yet and it's still early days. The way they go to market is through global SI partners. In terms of under monetization of areas, they might be under monetized from a queue subscription standpoint. For example, OpenAI has a lead here, and AWS may not have substantial revenue around queue. And then, of course, they are not monetizing their chips because the way they monetize their chips is through the AWS platform. Let's take a look at Google. Google primarily has a subscription around their LLMs, Gemini, and they recently released an open source software LLM called Gemma. And they also, of course, have their Google Cloud Platform, and they have TPU chips, which are their primarily their chips for training and inferencing. From a business model standpoint, they do have the Gemini subscription, they have the cloud platform, which they monetize, and then, of course, APIs and services. From a pricing standpoint, their pricing is primarily subscription based for Gemini and usage based for Google Cloud. Go to market continues to be their GSI and SI partners. And where they might be under monetized is one is sort of doing, having a monetization angle for their meta information that is in YouTube and Google search and all of these Google properties, which is pretty rich. And then, of course, they're probably under monetized from a chip standpoint, which is their TPUs. And it's possible that their primary monetization for TPUs actually occurs through the Google Cloud platform, and they don't really need, or they don't really yet see a need to monetize TPUs separately as a separate business. Now let's take a look at Meta. Meta has a very different strategy towards monetization. One is that they're open source LLMs, which is Llama. They've basically followed a very scorched earth policy, i.e., we're going to make open source so good that people may not need to actually pay for LLMs in the future. And then, of course, they've built in some AI capabilities in their glasses or Oculus. And a lot of those glasses and Oculus tend to be one time purchases. So their pricing is either free or one time. And from a go to market standpoint, they are a very direct to consumer company, and they might be under monetized a little bit from a cloud standpoint. So, if, for example, if Facebook were to spin up their own cloud in the future, they would be looking at an additional monetization of that AI capability. For Microsoft, they're really monetizing across the board. Whether they have their own LLM and chatbots, which is Copilots and GPT from OpenAI. They also have their cloud platform, which is Azure, and chips, which is Maya for AI inferencing, and then Cobalt, it's for high performance compute. From a business model standpoint, they have a subscription business model in place. They have a cloud platform, and then, of course, they've got APIs and services. From a pricing standpoint, they have a subscription business model and a pricing model. And then, of course, they have usage based on Azure. Their go to market tends to be more GSI and SI focused. And from a services standpoint, they might be slightly under monetized for now, but Microsoft, make no mistake, Microsoft is one of the best monetized examples of AI infrastructure. and they're doing a really good job of monetizing co-pilots, cloud platform across the board. We're not sure if their chips are really ready for monetization externally as an independent business, but it seems like they're more aligned to monetizing their chips through their cloud platform. Let's take a look at NVIDIA. NVIDIA, again, the king of GPUs. It's the platform of choice for generative AI infrastructure. So their GPUs, the A100s, which was the original sort of the AI chip, which was superseded by the H100, and the H200 is likely to be announced very soon. And then they also have the software layer, the cloud platform called NVIDIA AI, which includes CUDA. And the business model tends to be centered around chips, which is a one time purchase. And then, of course, they've got all their cloud and software libraries, which is available as a subscription. Their go to market tends to be through hyperscalers, Amazon, Google, and Microsoft, and others. They might be a little bit under monetized from a cloud and networking standpoint. From a Tesla standpoint, we think they might be able to take advantage of X's Grok LLM, but at the heart of Tesla's AI is the Dojo system and Dojo chips. Their business model is around premium connectivity for Tesla and the full self driving, the FSD platform. Their pricing is a connectivity subscription and the FSD subscriptions as well. Their go to market is direct. Under monetization for Tesla, I mean, it's possible that in the future they may be able to build their own cloud platform or even be able to license out their FSD platform for other car companies. So there might be some monetization opportunities for Tesla in the future. And as you can see, there is one company that stands out here that has not made major AI announcements. We don't see a lot of AI currently in their products, but it's quite likely that they may be building a lot of AI infrastructure for their devices as well as their cloud products. And that is Apple. And my sense is Apple is the dark horse of the AI race, but please don't count out Apple yet. They're one of the world's largest companies. They have a ton of R&D budget and expect Apple to make waves in AI in the coming quarters and years. Now that we looked at the monetization of AI across Magnificent Seven, one of the interesting players within the Mag 7 is Google. And the question really is Google the next IBM? And there's been a series of missteps that Google has made lately that really begs the question, is Google the next IBM? Google recently released Gemini, and as users started using Gemini, it realized that the Google's image generation, as well as a lot of the answers and responses, were not factually accurate. And it seemed like there wasn't enough testing done, not enough red teaming and validation done, which led to very incorrect answers to many sort of easy questions that you would expect an LLM to answer. Part of the issue here is that many of Google's staff are trying to do social engineering, and they're trying to use the reach of the Google platform and the enormous technology capabilities to overcorrect social problems that they see in the world. And that has led to inaccuracies and, quite frankly, quality issues with Google's Gemini LLM. Sundar recently sent out an internal memo which kind of felt more like a marketing email that said, hey, this is clearly a problem. We need to solve it. And we need to make structural changes. We need to do more red teaming and things like that, which was all good. But at this point, Google needs to show more action than words. And it seems like, all of this internal memo, etc., is only creating more issues for Google. And if we look at the competitive landscape for Google, where, on one hand, they've got OpenAI's ChatGPT, which is kind of the most used generative AI platform right now. And also, you've got some newcomers like Perplexity and others. All of this generative AI chatbots are creating a impact for Google search business. And if Google search volume goes down, then its ad business will also is also likely to suffer. Compounding the current situation is there's issues with Google's branding and marketing. And you don't need to just take a look at Google Cloud CEO's tweet the other day, where they were talking about releasing Gemini Business as a new capability. And if you read this tweet, and I'm just going to read that verbatim here, this is what Thomas is tweeting. We're introducing a new offering called Gemini Business, which lets organizations use generative AI in workspace at a lower price point than Gemini Enterprise, which replaces Duet AI for Workspace Enterprise. And if you really read this tweet, it's like you got Gemini Business, Workspace, Gemini Enterprise, Duet AI, and Workspace Enterprise. You're mentioning five different brands all in the same single tweet, and you're really confusing the customer in terms of what is the customer supposed to buy or pay attention to. And this is classic issues which happen in big companies, and Google is no exception. And Google just needs to simplify and focus its marketing and branding. And the last part of this is this a solvable problem? And the answer to that is absolutely a solvable problem. The question is, will Google solve it soon? Because if Google doesn't solve it soon, then we may see leadership transition at the highest levels in Google. In fact, if the problem is not solved, I see more than a 50% chance that we may get a new CEO for the company. However, if Sundar and team are able to fix this problem, I definitely see a much better Google emerging from these problems. Last week, Berkshire Hathaway announced their Q4 2023 results. And of course, Warren Buffett's annual letter to shareholders came out. And, Buffett's letters to shareholders are a masterclass in business. And after going through the letter this year, three things really, really stood out for me. First was a eulogy to Charlie Munger. Here's what Warren writes about Charlie. In reality, Charlie was the architect of the present Berkshire, and I acted as the general contractor to carry out the day by day construction of his vision. Charlie never sought to take credit for his role as creator, but instead let me take the bows and receive the accolades. In a way, his relationship with me was part older brother, part loving father. Even when he knew he was right, he gave me the reins, and when I blundered, he never reminded me of my mistake. In the physical world, great buildings are linked to their architect, while those who had poured the concrete or installed the windows are soon forgotten. Berkshire has become a great company. Though I have been in charge of the construction crew, Charlie should forever be credited with being the architect. What an amazing homage by Warren to his longtime mentor, partner, and friend, Charlie. I thought this was one of the best examples in business of how you pay respects to someone who has recently departed. The other thing that stood out for me in Berkshire's annual letter to shareholders was Munger's advice. Again, I'm going to quote Buffett directly. Charlie told me correctly that I had made a dumb decision in buying control of Berkshire, but he assured me since I had already made the move, he would tell me how to correct my mistake. In 1965, he promptly advised me, Warren, forget about buying another company like Berkshire. But now that you have control over Berkshire, add to it wonderful businesses purchased at fair prices and give up buying fair businesses at wonderful prices. In other words, abandon everything that you've learned from your hero, Ben Graham. It works, but only when practiced at small scale. With much backsliding, I subsequently followed his instructions. What Warren is saying here is something that is so difficult for a business leader who's tremendously successful to say that his strategy is flawed and then to take up a different advice which is antithetical to the original strategy of the company, and to not only adopt this new strategy but actually use it, manifest it to make business growth happen using this new strategy. This is an incredibly tough thing to do, and Warren did it. He paid attention to Munger's advice of buying great businesses at fair prices rather than buying fair businesses at great prices. The other key takeaway I had from reading the letter was around what is the core goal at Berkshire. You know, as you know, Warren keeps repeating these simple and key themes across all the letters. And it's just a great reminder for all of us to focus on the basics and get the basics so right that these basics continue to give us the results that we are really looking for. And this is where Warren jumps in and talks about business with good economics. Warren writes, our goal at Berkshire is simple. We want to own either all or a portion of businesses that enjoy good economics that are fundamental and enduring. Within capitalism, some businesses will flourish for a very long time, while others will prove to be sinkholes. It's harder than you would think to predict which will be the winners and losers. And those who tell you they know the answer are usually either self delusional or snake oil salesmen. At Berkshire, we particularly favor the rare enterprise that can deploy additional capital at high returns in the future. Owning only one of these companies and simply sitting tight can deliver wealth almost beyond measure. Even heirs to such a holding can sometimes live a lifetime of leisure. Warren is talking about investing in companies who can produce great returns when you invest more capital into them. And by taking care of just good economics, you can have a phenomenal business that just doesn't last for a few years, but it can last for lifetimes. And it can generate returns for investors, not just in the short term, but for a very long period of time. That's it for this episode. I'll see you in the next one.